Hey everyone, I'm Charting Man Dan with the Chart Guys. We're going to have a long video today. There's a ton to talk about. We're going to go through the charts like we normally do, the major ETFs and individual names. I'm then going to talk about what I'm doing, how I've been positioning, and what I'm looking to do in the future, of course, and a bit of the bigger picture stuff. So I suggest sticking around for all of it. But first things first, obviously bears in complete control. Fear is a lot more palpable here than it's been in a long time. In response to Trump tariffs, looks like the market either thought he was bluffing or, it was clearly worse than they expected. I'm very surprised to the magnitude of the two-day dump that we've seen. When you know the date it's coming, you know it's a bearish event for markets, to still dump that much on a somewhat known, again, the details weren't known, but known enough that you wouldn't think that there would be this magnitude of a reaction. So that was definitely surprising, but we'll see where we stand. And bigger picture, I'm going to be doing a live stream a week from this Thursday where we're going to be looking bigger picture, 3-month charts, monthly time frames, one of the longer term pattern videos that we do every now and again. This, we're going to be focusing on the monthly, the weekly, the daily, and most importantly, the short term. When are we starting to look for a bounce? So let's get to the charts and go. All right, so we'll start on weekly timeframes and zoom in from there. This is the S&P 500 ES, the futures chart. Again, huge red candle, weekly oversold. When's the last time we hit weekly oversold? We got down there just about to that level in 2022. Just for continuity's sake, again, going over some of the videos from the past weeks and months, there were red flags just one by one. We've been talking about checklists, right? What are the bear checklists? What are the bull checklists that they want to see accomplished? And first things first, we had the first bear signal was losing the weekly higher lows for the first time. And we could say, okay, things are different for the first time in 6 months when that happened. Then we had a close under, more notably for the NASDAQ, a close under monthly EMA 12, not long ago, a few days ago, for the first time in 2 years. So we went, okay, something's different from the last 6 months, different trading environment. Okay, something's different than the last 2 years trading environment. We have to be adjusting with that. We're either pumping the brakes and trading less. We're shifting our mindset because the trading style that worked for the last 2 years will not work in this current environment. And we just keep getting these signals. And now you look at the NASDAQ and the S&P 500. With where we stand right here, the weekly RSI being at 27, it's not massively crushed. But you look back and we are, that's not even CVID. We didn't even get there for the CVID dump. We're lower right now. So it's very meaningful. This is, you're looking at, if we have a red week this coming week, the NASDAQ weekly chart will be the most oversold it's been since 2008. So then we would say, okay, this is different than we've seen in the last 17 years. So we're definitely paying attention that things are massively shifting. And again, I'll talk about it more in the long-term patterns video live stream that we'll do. But there's a ton of charts that have a lot of space for a monthly lower high. And the definition for a bear market is, minus 20%. And I hate that definition just because it's way too simplistic. You can be in a bear market for a day or a week and you can bounce out of it. For me, time is such an important factor for a bear market. You need to grind down. You need the relief bounces where you think, oh, it's over, and you drop to lower lows. And again, I've only been trading for 14 years. So being in a post-2008 world, I've only seen a glimpse of a bear market in 2022. And that's what it was. Just prolonged, grind down, monthly lower highs and lower lows. Oh, a little bit of relief. Nope, lower lows. And that took place over, 8-10 months. And you just get worn down. And so when you get these flash dumps to 20% and V-shaped recoveries, that's not a bear market. So the next big check mark for the bears, and again, they've just been checking them off. Everything I say they're doing. But the next big one will be confirming a monthly downtrend. You need that psychological impact on the market. You need to have a 10% bounce where you say, oh, okay, we're out of it. We're V-shaped and all-time highs back in the picture. And then you roll over to lower lows. That you got to, kick the hope out of the market if it's a longer-term bear market. So that's the next major check mark, is when this temporary bottom is, or when this bottom is in for now, whenever that is, sooner rather than later, in my opinion, because of how extreme we're getting. But when that happens and we get a monthly bounce underway, do we confirm monthly downtrends? That's the next big long. If we do, tops are in for the year probably, and maybe even longer. If we don't, then there's a potential V-shaped recovery. There are plenty of times in the past where I've expected lower highs in the indices, and we V-shape back to all-time highs, whether it's money printing, cutting rates, whatever it is. So I'm open to anything, but Again, there's a lot of space on a lot of names for monthly lower highs to shape up now. So let's zoom in. The thing that we talked about last video is we knew here that a day, so we said, okay, weekly bear flag confirmed. Check mark for bears. Got to confirm a daily downtrend from here to follow through with that, because if you don't, it's a bear flag with no follow through, and that's a bullish indication. And so we bounced. We knew the daily lower high was the most likely scenario. Again, didn't expect a free fall, but we confirmed the daily downtrend and followed through in a big way. So you look at the daily RSI right now, and it's crushed. And again, RSI, I'm going to talk about our super stack indicator. And it's essentially what we did was, okay, one of my edges as a trader is oversold bounces. So how do we quantify that? Well, what am I doing in my brain when I'm making these trades that work out more often than not? Playing counter momentum and playing counter fear. And so for me, it's when all the time frames are aligning in extremes together. If the daily RSI is 25 and the hourly RSI is 42, then it's not the same setup as if the hourly RSI is 23 as well. Why does that matter? Because if all of the time frames are aligned in extremes, the probability is higher for at least a short-term relief bounce to allow you to position. And so the dump on Thursday, big red is not enough for me to look long. I was not looking long on Thursday because we were not at extremes. Only, the NASDAQ was just getting some time frames oversold. And so I needed another leg down. We got that leg down on Friday, and I was looking long. I did take an Amazon trade, and it worked out, but obviously that's not the bottom. And so my mindset as a day trader is, I hope we gap down on Monday. I want to get as extreme as possible because that's going to mean a better bounce. And again, I'll talk more about my personal positioning, IRA versus day trade and things like that. But that's what I'm hoping for on Monday, just knowing that I am mostly cash. But we'll see if we get it. And again, the super stack indicator, and shout out to Toby for making this, because it does save me time. Seeing all the RSI levels in a snapshot saves me from going time frame to time frame to time frame to time frame to get the complete picture. But again, look right now, we had a short-term bounce into the end of the day where 5-minute, 15-minute, 30-minute, none of them are oversold. So we're keeping an eye out because some super stacks did fire. And super stacks on the daily time frame are meaningful. They've done a good job. We don't have a ton of history because this indicator is only, a couple years old at most. But the ones that have fired have been good ones. And let's zoom out here. So again, the NASDAQ fired the daily super stack on Friday, which gets me interested. Doesn't mean I'm just, all in and hopeful. That's one piece of the puzzle that tells me, okay, we're now getting extreme. But again, looking back historically, we had the weekly super stack right before the August dump. We had a daily super stack elsewhere in there. 12-hour, the NASDAQ had a day. Anyways, the longer term ones, even for Bitcoin, they've been playing out well. I like the longer term ones because they have solid probabilities in terms of when they play out. So it got my attention. And that's why I traded Amazon, which we'll talk about in just a bit. Amazon had a daily super stack. So anyways, all that said, super stack tells me we're getting to extremes on all the time frames together when that is happening. So I'm definitely interested in a bounce on Monday, and I hope we get a gap down to try and position. My style for positioning is, catching a falling knife can be brutal. You have to have stops on every trade because we have environments where what kills professional traders is you can do something that works 99% of the time, and the 1% of the time it doesn't work, it can blow you up. And in my earlier career, when I was more aggressive, I was much more open to scaling in to maximum fear. And it worked really well in 2017 crypto. It's worked, really well plenty of times in the past. But the more my capital has grown and the more, I'm putting myself at risk in that kind of scenario, I recognize, well, what if you get oil going to below zero, negative? What if you get VIX Armageddon, whatever it was, when I forget the ticker off the top of my head, where that volatility ETF broke and went to zero? There are anomalies that happen. What if, yes, we're at extremes right now in the short term. What if a hedge fund blows up on Monday and has to sell $100 bajillion and everything dumps down to RSI levels we haven't seen in decades? That could happen. I don't know. So I have to protect against the anomalies. And so even if we're in extremes, I'm still using stop losses to prevent that from happening. And if I try a bounce and then I stop out, then I can just try again on another leg down. Obviously, I don't want to just be constantly, beating my head against the wall doing counter momentum trades. But if I'm, limiting my risk or stopping out break even, then that just means, okay, we'll try again later. And so again, just an example, my Amazon trade from Friday, I haven't traded Amazon in many months, probably over a year. Why did I choose to trade it Friday? This is the beauty of viewing the market as a whole. Amazon's on my screen. I got 20, 25 tickers on my screen that I'm watching every day. Why? Because it's one of the most important individual stocks in the market in terms of its weighting in different ETFs. So I've seen the relative weakness in Amazon consistently over the last bunch of weeks. And it stood out glaringly. Amazon has relative weakness. And then the contrast is what often stands out to me. So recognizing in the first 5 minutes of trading on Friday, Amazon has relative strength for the first time. Again, if I'm not watching Amazon daily, that doesn't stand out to me, but it's the contrast of what it has been. Amazon, it was the first sign, 934, slight relative strength since open. So what I did is I grabbed a swing position just to market buy right on the open because that's much smaller. I don't need to worry about it. It's super stack oversold. I can start scaling into a swing position. When I saw the relative strength, I then grabbed a day trading position. This day trading position is 10 times the size of this position. So I didn't have a stop loss that I cared about. It's essentially like I care about my day trading position account when the market's open. All right, I'll grab a tiny little piece here, but I care way more about more size, obviously. Why did I use more size? Because at that point, as soon as I buy 169.53, I've got my sell order filled out and my finger on the button, and I'm just waiting for a red flag. And I would have been all out if we dropped $1. But fortunately, the relative strength very glaringly followed through all morning, even though the NASDAQ kept dropping. There's one point in time where Amazon was 5% above its low of the day, while the NASDAQ was like 0.2% above its low of the day and testing. So the relative strength made it very easy to hold this position. And I scale out. I turn day trades into swing trades where if I've got, let's just say round numbers, if I got 1,000 shares and I want to swing 200 shares, then I can scale out 800 shares along the way. And let's just say I'm in 169.56. Let's say I exit 400 at 172.56 and 400 at 175. I don't want to cherry pick nail on the top. Yeah, 175, whatever. That gives me an average where now my break even on my swing position is under the low of the day. And I did hold that position. I didn't like the end of the day, 2% drop, but I did hold that position over the weekend because if we gap down, we'll be getting back down towards my break even. And even if we gap down to 160, it's a swing trade position size, and that's not a huge deal for me. So that's how I try and position, get a profit cushion to be able to hold some swings in a more volatile, uncertain environment. But again, the daily super stack is why I was interested in Amazon, and for good reason. Again, that tells me that it's when that fires, the daily, the 12-hour, the 4-hour, the hourly, the 30-minute, the 15-minute, the 5-minute, not just all oversold, they're extreme oversold. And so again, from there into the high of the day, that's a 9% bounce. That's a lot for Amazon. And you're going to see that kind of volatility. What I find tricky as a bear in a bear market, and I learned a lot in 2022, is, you get these face ripper bounces that are just lower highs in prolonged downtrends. And I have a really hard time holding bear swing positions through 5 to 10% bounces. It requires a lot more activity, in my opinion, in terms of taking profit and reloading, because again, I will never just sit through a position losing 10% on a swing trade, really only an investment. I'll let that kind of long leash go. So I am interested, let's just sum this up before we move on. I am interested in oversold bounces. I am definitely still using stop losses on trades. I'm trying to position where I sell partial to get comfortable and have a break even to let it play out. And then we're just going to look for a daily low or high, right? So when we find a short-term bottom, and the fact that we closed near the low of the day definitely has fear swirling over the weekend. We even dropped down a bit after hours. But again, we are at levels where we expect at least a short-term capitulation bounce, and a futures 4-hour bounce is what I'm going to be watching for towards the start of next week. The hourly EMA 12 is a great guide the last few days since the tariff reaction. And part of the reason we didn't get extreme until, the 10% drop is because of the bull move up the days, we bounced 5% plus leading into the tariffs. Then we had a bull reaction while he's talking. So RSI levels are getting towards overbought, which means you have to drop much more for those to then get oversold. But look at the hourly EMA 12. Reject, 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 reject. All the last 2 days, I've just been saying, if hourly EMA 12 is resistance, the bears have complete control. Nothing is changing. And with where we stand right now, let's just say we opened right now and tried to get a bounce going, we can bounce 2% before we even get to that resistance. So that's my guide. I know nothing is changing if hourly EMA 12 is resistance. If we get over it, I can say, okay, now maybe I have a bit more faith in a swing trade attempt. But again, I like breaking things down into aggressive, conservative, bear, and bull. An aggressive bull is looking long into the fear. A patient bull is waiting for a big enough bounce to then look for a higher low, keeping in mind that oftentimes you just get that V-shaped move when it's this volatile. A patient bear is waiting for a futures 4-hour lower high or a daily lower high. And an aggressive bear is, just trading opening range bear breaks or hourly lower highs. So you need to determine what you are. And then you break it down into, am I looking at investing? Am I looking at a swing trade? Am I looking at a day trade? Those are three very different things with very different approaches. We'll talk about a bit more in the end of this video. So semiconductors, monthly chart rolled over. We've been trading sideways in semis for a while, almost a year, 8 months plus, big bear break. So again, in the webinar, we're going to be talking about quarterly charts. And quarterly charts did help me find the bottom in 2022 and go long and have more, long IRA exposure for a longer period of time than I've ever had in my trading career. And it was because of the quarterly chart. So, I know the bears are like, yeah, bulls just keep zooming out to find some kind of uptrend. And that's true to a certain degree. But, I am looking for, let's just quickly look at, the S&P 500. We were giving back a straight up move and we give back half of it. So definitely still open to a long-term higher low forming. And that's where the monthly downtrend confirming or not becomes so important. So semiconductors bears, NVDA, at this point, again, investing, swing trading, or day trading. If you're investing, being down 40% from the all-time high, okay, you could start nibbling some long-term exposure perhaps if you want. Look at the 3-month time frame here. We're going to form a 3-month higher low. It's just a question of where. So obviously that's the tricky part, but there are no red flags in this long-term chart. This pullback is definitely inevitable. You don't just go straight up. And when you do go straight up for hundreds of percent or close to 1,000%, you retrace very significantly because you don't build a ton of supports along the way. But a 3-month higher low, and I have more confidence saying NVIDIA is going to form a 3-month higher low than almost anything in the market. So we will be looking for that eventually. We had a number of bear charts that we were watching from the video last week. And I said that if the bears are going to be for real and see significant weakness, XLF and XLV must confirm their head and shoulder patterns. And they did. XLF, beautiful head and shoulders. The bear break was at 47.05. One of the things that I did poorly, that I could have done better, again, you're never going to nail tops and bottoms, so we have to be gentle with ourselves in that regard. There's always going to be something you could have done better, and hopefully there are some things you did do well. So the things that I could have done better, I had a good short entry on XLF Thursday, nailed the double top at the high of the day. We had 5-minute overbought back burner. Remember those back burners work in bear markets as well. 5-minute overbought bear, super bear, back burner. Double top at the high of the day. I shorted there and I nailed it. And I didn't swing it because I thought we were starting to get to extremes. I'll start with a clean slate tomorrow. Obviously, it would have been a huge win overnight if still in that position. That's the way it goes. Some of the times, it's hard for me to shift from day trade mindset to swing trade mindset, but we confirmed that week. I should have held that position for the possibility of the weekly head and shoulders because I've been watching this for 3 weeks. So that was a lesson. But again, tons of space for the daily lower high. We're still in free fall at the moment. We don't have a bottom. We're going to look for an hourly lower high. We'll actually have a short-term resistance here, 45.10 to be watching. But again, patient bears just waiting for a daily lower high. Aggressive bulls starting to get interested. Again, another name, 3-month time frame, no red flags whatsoever on this chart. Just got to keep that in mind, right? Daily time frame, red flags, fear, free fall. 3-month time frame, no, not even close. I mean, look at the back test of all-time highs. We would need to drop another 11% in XLF to even backtest the previous all-time high and to test 3-month EMA 12 support. So again, if we're going to be talking about a multiple year top or things like that, I see so many, obviously emotions are running wild on social media. People talking like, this is just like 2008. I'm nowhere near saying that at this point. So maybe that'll change. Maybe I'll be wrong, but I'm not at that level of fear. No way, not yet. XLV, I love the setup on XLV just because I love when there's fractal patterns. This was a 2-day head and shoulders we were talking about. And it was a 2-day head and shoulders to form the right shoulder in a monthly head and shoulders. And we've been talking about this monthly head and shoulders for 5 months. In the long-term pattern video to end last year, we were right here. And I was talking about if we hold this support, we're going to scout the monthly lower high and watch for this head and shoulders. Why was I looking for a monthly head and shoulders? Because the 12-year chart just gave us the most bearish yearly candle in 15 years for healthcare. And I'm looking for yearly consolidation in this sector, and it is definitely shaping up. And we're going to look for a yearly high or low above 67.98, but it may take, I was talking about in that video, we may be putting in the top in the healthcare sector for multiple years with how this chart looks. And that is a higher probability now. Just need to break 133.32 to get that going. And again, another one where I love where I'm positioned comparatively. Day trade account all-time highs, IRA definitely down. But I fumbled the bear side this week because, again, I had an XLF short on Thursday. And when we broke the high of Wednesday, I stopped out. And it was a pretty, like an insignificant, tiny loss, pretty much break-even stop out. But, man, would have been if I held that and XLF, accounts would be ripping in all-time highs from Friday's move. But again, just lessons. I'm definitely doing better than the CVID dump. I'm doing better than the 2022 bear market. Still have some hedge positions in my IRA. Only a third of them. That's another thing I could have done better. Again, you can always do so many things better. And this is coming from the professional with a day trade account at all-time highs, but could have done, let's see, what was the thing I did wrong here? Oh, so I scaled out my hedge, 2/3 of my hedge into this weakness. Great. We bounced and I didn't reload aggressively enough. It was a weekly bear flag. I should have reloaded 1/3 at least, and I didn't. So again, my IRA right now down maybe 5-6% from all-time highs, considering it's the vast majority of SPY is my holdings. I bought it during the CVID dump. I bought it during 2022. I guess we're mixing the me part with the analysis part, but considering that the S&P 500 is down 17%, and that's the vast majority of my holdings, and I'm down 5 to 6%, that's a job well done. As far as the overall accounts, all of my accounts merged together, I'm down, my all-time high was earlier this week, and I'm down maybe 2%, 1 to 2%, because my day trading account has been doing well. So, plenty of mistakes, always plenty of mistakes. Someone was getting into it. I was talking to my friend's post on Facebook, and someone, because I didn't expect this much downside, and so they're making fun of me. It's like, dude, being a professional day trader, I am literally wrong. I have been wrong a bare minimum of 1 time every single week for the last decade. When you're making a dozen to 2 dozen decisions every single week, you're going to be wrong 1 to 3 to 5+ times every single week. And we're talking 52 weeks times 10 years, 520 weeks. I have made a mistake at least once every single time. How am I still doing well in this game? Because you learn from them, you stop out quick, everything you've all heard before. But when people harp on someone being wrong, if you're consistently wrong, okay, harp on them. But being wrong is such an ingrained part of this game that it's almost like you see someone making fun of a trader who's wrong. It's like, oh, you're new. You don't understand this game. This isn't for you. So embrace the wrong, as I am doing right now. What next? So XLV, again, we'll bounce eventually, but this is a beautiful 2-day head and shoulders into a monthly head and shoulders. And if we break 134.81 more convincingly, the monthly head and shoulders confirms, the yearly consolidation gets underway. We then look at this previous resistance zone, which is what we're testing now. Then we would be looking down here. So again, XLV is the weakest of the major sectors from a longer term perspective because nobody else is confirming a monthly downtrend. XLF, we're coming straight off all-time highs. It would take 3 months to confirm a monthly downtrend. QQQ, straight off the all-time highs. It will take multiple months if we're going to confirm an eventual monthly downtrend. XLV is already doing it. Tesla, relative strength in the sense that we got ugly a while ago. We're holding that low for now. Relative strength was glaring on Thursday, but we did roll over with the market a bit on Friday. But I'm interested. You know, I love when I'm looking at relative strength and relative weakness. Oh man, we got a 40-minute video coming. When I'm looking at relative strength and relative weakness, I love when the NASDAQ breaks to a lower low and an individual name does not. Tesla, I was longing Tesla Thursday and helping my day trade account by doing so. Nope, it wasn't Thursday, it was Wednesday. Yes, so Wednesday, quick example, double bottom at the low of the day to the penny into a solid bounce, 261 up to 271, 4% bounce, a little less. And at that point in time, the NASDAQ was dropping to lower lows. I look for a name that holds support when the NASDAQ drops to lower lows. If I'm looking bearish, I'm looking for a name that fails its resistance, it fails its high of the day when the NASDAQ or S&P 500, depending on which individual name it is, hits a new high of the day. And so here we have, you know, if we can say that Tesla's positioned well in the sense that it has nearby support from recent price action, and if the NASDAQ reaches a capitulation bottom Monday or Tuesday, Tesla's going to hold these lows and will be still range bound likely, but in a much better place than so many names that are in free fall right now. So there's levels to play off of, which is different for many names. So I'm definitely paying attention to Tesla if we hold the support zone into this coming week as a potential bounce play. And when I am playing extreme bounces, I like to get the weakest of the weak, and I like to get a name of relative strength. I essentially diversify my bounce attempt in a couple names because oftentimes the weakest name will see a greater percentage bounce, but sometimes the relative stronger name will continue that relative strength. Just one quick shout out to relative strength. Bitcoin, got to point it out. I mean, altcoins, as far as I'm concerned, altcoins are penny stocks, and they've been dumping for 8 months, whatever it is. The last 2 days when the market's falling apart, a bunch of the altcoins have been green. We're flat pretty much today, but a bunch of the altcoins have been green, and Bitcoin has been doing a really good job. I mean, again, we're correlated to the NASDAQ with Bitcoin, but look at this weekly bear flag confirming with massive follow through. And here's the same weekly bear flag on Bitcoin. It hasn't confirmed yet. Now, could it be a laggard and roll over? Absolutely. But we can say this is the most significant relative strength that Bitcoin has been showing in a long time. And if you look at Bitcoin divided by the NASDAQ, you're seeing that we are at, that's not right. Should be up more than this. Hold on. Bitcoin divided by the NASDAQ. Maybe not. All right. Anyways, we're at multiple month highs. I thought we were testing. That chart doesn't look like what I looked at recently, which is why I'm thrown off a bit here. Pause. It is the right chart. I must have been looking at the wrong one last time. But anyways, it's the strongest Bitcoin has been to the NASDAQ in 2 months, and we're approaching all-time highs. So it definitely stands out that Bitcoin is not dumping. And, you know, people are whispering, is this the decoupling finally from that correlation? Are we starting to act like a safe haven? Who knows? But we can clearly say that Bitcoin relative strength this past week was glaring because everything was dumping. So just got to give Bitcoin a shout out. MSTR also trying for, I mean, again, just holding up so much better. Look, MSTR was green, right? Green on a Friday? Are you kidding me? Handful in GME was as well, so not necessarily the blue chips, but it stands out. So still watching the quantum sector, RGTI weekly equilibrium. Again, try not to pat myself on the back too much, but we called this weekly equilibrium here 2.5 months ago. Why? Because equilibrium is the most common pattern. It happens when you have massive volatility in both directions. We certainly had that. I haven't been trading the sector in a long time. If you look at why my day trading account's doing well this year, it's Tesla, RGTI, and QBTS. That's it. 2 of the 3 being the quantum sector from January. But I pump the brakes because there's way more opportunity here than there is here. So we adjust when the market environment changes, and when we get good at recognizing equilibriums, it makes it easier to know when to be aggressive and when to pump those brakes. So I'm still interested in the sense that RGTI did defend support at $7, so it is still holding. I mean, we broke it by a couple pennies, but as far as I'm concerned, it is still holding. It can easily roll over this coming week, but if it were to hold, again, that would be enough, like a level to play off of, right? Just like Tesla. Give us a level to play off of, and it gives us a bit more of a safety net than something that's a falling knife. The other names, QBTS, a weekly higher low is the most likely scenario. There's a good bit of support in the $5 to $6 range. So again, just keeping an eye out on these quantum names. They're essentially just a leveraged version of the NASDAQ. They'll go up 2 to 3 times as much as the NASDAQ on a big green day, and they'll drop 2 to 3 times as much on a big red day. But overall, definitely still keeping an eye on them. IONQ, potential weekly bear flag, but we will, again, monthly equilibrium is going to probably come here. Just like that weekly on RGTI, IONQ, we're going to likely form a monthly high or low, then we'll bounce and form a monthly low or high. So again, it's going to depend on the NASDAQ, but that's what I'm looking for, a bigger picture there. All right, on to commodities real quick. Dollar. So dollar, weekly bear flag confirmed, following through. Next major support zone is in play now. Again, look at all these lows down here. Let's just draw this range, and we're approaching it. Held it 1, 2, 3, 4, 5 times on the monthly. And so back in play. Still a sideways range overall. Gold sold off on Friday. When you get significant fear, and go back and look at 2008. Again, look at I made a video, Dan's plan when it hits the fan, talking about being prepared for big fear, because we were in euphoria when I made that video, and then CVID happens. It was really good timing a couple months later, but that's a really good video. Just look up Dan's plan fan chart, guys. And I talk about how in 2008, when there's major fear, everything sells off together, and the relative strength and weakness really presents itself when the dust starts to settle. You shake the snow globe, and all the flakes are going crazy, and then as they start to settle, you see where the money is rotating to. Utilities did dump on Friday in a big way. Thursday, they stood out. I mean, it changes so fast, right? And a lot of that to do is with the VIX spike. Huge VIX spike up on Friday. But, gold held on fine Thursday. Utilities held on fine Thursday. Those are the safe havens. And then Friday, it's an oh shit moment where, okay, sell everything. And I was in that boat a little bit in the sense that, I still have my minor swing positions. I recognize the red flags, and I sold half of my remaining swings, maybe not that high up, but on the morning bounce of Thursday, saying, okay, this is potentially a second opportunity to lighten up because it is getting to oh no moment. And then I put the stop under the low of that day for the rest to ensure profit from entries. I forget when, somewhere back here, but out of those positions now. And again, huge red day for the miners. Still a weekly uptrend, but gold, weekly consolidation potentially shaping up. Again, we just ran so much. Monthly consolidation won't surprise us the next time it happens. Step 1 is for bears to confirm a daily downtrend. We're going to be watching for the possibility of a head and shoulders on gold on the daily chart. Still no major red flags, but when fear is contagious and it hits everything. And again, you go back to 2008 and the metals were dumping and utilities were dumping, at least to start. So again, that safe haven narrative is a little bit of a shield, but not for significant fear. Significant fear penetrates all shields. Silver, massive dump. This was some of the most oversold short-term. I think we broke a record in terms of, I forget what time frame, maybe the 4-hour, most oversold it's ever been. On some, 4-hour RSI right now is 10.5. It's testing monthly support we rejected. I talked about, the most important thing for those miners is silver's got to break this 12-year high. If we reject, it's definitely a red flag. Well, we rejected very hard right from resistance, and now we're testing monthly support, and it's a potential monthly head and shoulders. So we'll look for an oversold bounce. We'll look for a 4-hour lower high, 4-hour stair step right now. When you're in extreme volatility, stair steps work a lot better. And Google Chart Guys stair steps for that trading strategy, because it's a really good one that can help you get some really good entries. Just an example, QQQ, 5-minute time frame. If you're an aggressive bear, you're looking at this bounce straight off the low on the morning Friday, 5-minute stair step. Okay, we haven't changed any trends. We're approaching high of the day resistance. Again, it would only be the aggressive bears looking to short there, but as soon as you break that 5-minute stair step at 435.28, your stop goes over 437.92, so maybe $2. My brain just stopped working. $2.50, $3 risk, whatever it is. So 435.28, and then we just never get close to that stop out. It's just all bear from there. So it positions you, in stair steps, you can stop out a good number of times, but the risk reward is so favorable that, if 1 out of every 3 works, generally speaking, it would still be profitable in periods of high volatility. Oil, we've been watching this 2-month equilibrium. It's breaking bear. Look at how long we've been tightening up in this one. This is a 3-year pattern. We rejected right off resistance of 79.76 by 1%. And here we are breaking 61.37. Not by a ton, but we're breaking bear. So what does this mean? Zoom out, 6-month or 12-month. Is this a yearly lower high forming in oil? Sure looks like it to me. It's been a yearly stair step since the negative days. And again, we can easily see yearly sideways consolidation. Again, when monetary policy changes come into play, things get extreme. CVID, V-shaped low. So, there are many times where I have to withhold my experience of most likely scenarios, because a stock's most likely scenario is very different than the indices most likely scenario when there's a surprise rate cut or things like that. So I always remind myself that, when I say something like oil may tighten up for the next 3 years, I also remember that, anything could happen. Geopolitical, massive volatility, what are other countries going to do in terms of printing, yada, yada, yada. But again, a yearly stair step is breaking bear. We'll see if we get follow through. We knew the weekly lower high was the most likely scenario. We couldn't say we're going to free fall to straight lows, but it at least helps us looking in the right direction. Natural gas, I'm on the verge of stopping out. My last little runner along here. It's looking like a head and shoulders here as well. A lot of head and shoulders out there. So I'll stop out if this level breaks. And it's been a great run. It'll end up being at least a 50% plus win. I've been scaling, I recognize that. That's one positive, right? So I said all the bad things I did, could have done better. One positive I did here, did start selling on this candle, because that looked like a climax candle to me. Up 10% and you give it back in the same day. After a 100% move off the lows, climaxy. And that holds true. All right. So I've already talked a bit about myself, but again, just to summarize, so IRA down a solid bit from the all-time high, but very manageable. Again, boomers sit through 30% drawdowns when it's the long term. My IRA has a time horizon of 30 years. Hopefully I live that long. But, if I'm keep this weakness for another 5-10% down, and I'm going to be adding to the long-term IRA again. The only time I have added are CVID and 2022, the most significant bearish environments that I've seen since I had enough capital to be thinking about long-term. Prior, in my other decade of trading, before I had significant capital, it was all just day trading cash, didn't worry about a thing overnight. I loved that style. I still have the vast, my day trading account is 3 times the size of my IRA. I'm maxing out my SEP IRA, where every year it's more and more meaningful. Ideally, I'm getting to a point eventually where I'll be day trading in my IRA to skip the taxes. But day trading account is still way more important. And that's why, my combined accounts are only off one probably like 1.5% from the all-time high. So that's what I'm looking to do. And I'm also looking for the potential, when we saw rates start to climb, that's another thing that I had never experienced. And so being in a ton of cash and just getting a monthly check essentially every month has been so nice. I've never experienced that in my life. What do you mean I can get this much money for doing nothing while day trading with the cash and still earning the risk-free interest on it? That's been great. But when that happened, dividend plays sold off, because why am I going to hold a 4% dividend stock, which has the risk of up and down, when I can hold a 4% risk-free? So what I'm watching for is the potential that, if we start to get rate cuts later in the year or whenever, do we start to see a flow back into dividend plays? And I'm only just yesterday starting this mindset, so I haven't done any, I don't have any list prepared yet, but that's what my team's for. Red Devil in the chart, guys, is already on it. He's going to be, again, we're just sharing information, help each other out. So I am going to be looking for some potential long-term dividend plays. With this weakness combined with an eventual rate cut, I could see that being a potential good time for some long-term dividend plays. We'll see, one day at a time, but that's where I'm starting to think. Bigger picture. So I've talked about this a bunch on Twitter, maybe 3 or 4 times over the year. Talked about it in the Chart Guys room, so you guys have heard about it, talking about my dad. But just want to share bigger picture perspective. Number one, because I was right, and I need to boost my ego a bit after talking about how wrong I was this week and all the mistakes I made. But no, most importantly, just mindset, right? Bigger picture and technical analysis. So again, the email I sent to my dad March of 2024, so we'll just say a year ago, asking him how he's positioned. I asked because there's a potential we are about to continue this melt up for 15% plus, and if that happens, I will be very adamantly advising you to exit stock exposure into the euphoria strength. Everyone will be max bullish, leverage to the tits. As you know, I've never in my life suggested what he should do with his retirement, because he's done the boomer thing. You put your money in it, you hold through the drawdowns. He's been doing that for 40 years and it worked. He retired, he's traveling the world, it's great. Whether that works for the next generations, we'll see. But I have never suggested what you should do, but there's something unusual going on, and the harder we run at your age, the more you should be selling. We can circle back if the S&P 500 goes another plus 10% into the summer. It did. And talk about real serious about your game plan. We did. And because that's the premise shaping up. So we went plus 18% from there in the S&P 500. And it didn't look exactly like the blow-off top that I thought it would because of this sideways range. A blow-off top is what Meta did. That's a blow-off top. Straight up, we were green, 15 days in a row, 20, whatever it was insane. That's a blow-off top. I thought the market was going to do that. It didn't quite look like it, but the percentage move was enough to still take the actionable steps. I say, 15% plus more. We're now 18%. So, and, age is a huge factor. He's 73 now and retired. And he had 50% stock exposure. That is way too much. The NASDAQ went plus 116% from the 2022 low in 2 years. That is not sustainable. You can't hold those gains for a bigger picture. You have to see drawdown. And so again, if you're 52, you can hold for another 2 decades and you can sit through these drawdowns as people have been doing for decades. But if you have a financial advisor or a money manager or whoever, for your parents, your friends, for you, whatever, if they were not advising for you to be sizing down your stock exposure for a 65 plus year old into that euphoria, that's a major red flag. That's easy. That should be the standard decision-making process. What's the risk reward? What's the risk? Okay, you miss another 20% of upside. What's worse for a 70-year-old? To miss 20% more gains or to give back 20% of what you currently have and are mentally preparing for your retirement? And for me, the answer is always the second one. So he sized down considerably into the end of last year. Didn't nail the top, don't need to. Is that going to be, what if we V-shape and hit new all-time highs? Then it won't be a good call. It'll be, well, you could have just held through like you did all the other times. But if we keep dropping, if we drop 20, 25, 30% in the markets, then it will be the right decision. But again, it's just that mindset of euphoria. And note, the thing I want to tie this together is Note when I sent that email in March 2024, I had no idea who would be president. I had no idea anything about tariffs. I did not know one fundamental thing about what the reason for the drop would be. But I knew that the charts were saying this has to happen because it's inevitable. The run-up was way too similar to the CVID bottom that led to 2022. I mean, the metrics weren't quite as extreme, but definitely comparable enough to prepare for a longer-term drawdown in the same manner that we did in 2022. And so, again, that to me is just big shout out to technical analysis, where you don't need to know the why to know what a potential most likely scenario is. And the biggest factor for me, of course, the charts being overextended, but sentiment, psychology, herd emotions. Again, after the election, my neighbor right there, my friend's dad calling me, texting me, hey, I want to put some money into stock market for the first time. Huge red flag. There was so much euphoria. Crypto, Bitcoin's going up and it's insane. There were just plenty of signals of euphoria. And when you see that kind of euphoria after being in a bull move for 2 years to extreme percentages, Meta went up 750% in 2 years, you have to shift your mindset. When we're in euphoria, I'm constantly reminding myself, remember the fear, Dan. Remember the fear, because after euphoria quickly comes fear every single time. And when we're in the fear like right now, remember the euphoria. You're constantly, again, being a successful trader is rewiring your brain to do the opposite of what nature tells your brain to do. And right now, everybody's fearful. Again, I'm not saying buy hand over fist, but the people that were messaging me, and there was 10 plus of them, that I told not to buy to end last year because you do not go long term in euphoria, I'm now messaging and saying, hey, this is the fear we were waiting for. DCA, dollar cost average in, break it up into 20%. Buy 20% now, buy 20% in a month, and then the next month. Because this is the environment for putting capital to work for long term, 5, 10, 20-year time horizon. Because again, when I was loading my IRA for the first time ever during CVID and during 2022, I wasn't nailing the bottom. I was just scaling in. And I didn't expect to nail the bottom. I just knew that if I'm looking decades out, this is the kind of fear that I want to be buying. And again, I'm not adding to my IRA long-term multiple decades position right now because I'm just being a little bit more cautious, but drop another 10% and that will be on the table for sure. And as I mentioned, the dividends may be on the table regardless. So that's where I stand. This is the longest video I've done in a long time. I appreciate you sticking with me. There's lots to learn. Again, I can highlight 5 big mistakes I made and 5 things I did really well. And so if you find yourself getting down on yourself, write out a list, things I did well. Highlight the things you did wrong because you want to learn from them, but don't beat up on yourself. I'm so bad. I'm an idiot. I did the worst things ever. Because again, even the professionals are constantly making mistakes and constantly have things they could have done better. So that's the main takeaway. Stay protective. Use a stop loss. We got to protect. Again, closing at the low on a second gap down, 10% down in 2 days. I don't know if hedge funds are going to blow up. I don't know anything. So I have to protect against a potential 0.5% scenario, an anomaly, a market anomaly. Gotta protect against it. No matter what happens in these markets, I will not give back an amount of profit of my gains in my career that will have any significant impact. That also means I'm not going to double my net worth over the next 2 years, but that's the trade-off. And that's what you get when you switch from aggressive, which I was 2015, 16, 17, 18, 19, 20, and you shift to conservative. All right, do good things. I'll post a link for Superstack if you're interested. Again, this was definitely not a sales pitch. It's what I use. The Superstack's in my brain, but I do like that. Nice, save me some time. Little window there. Do good things. Establish a game plan in advance, right? The last thing we want to be doing is just going by the seat of our pants. Sit down at the desk Monday morning and start clicking buttons. No, write it down. Write it down. Get a pen and paper. Write things down. I cannot suggest that enough. Do good things. Interact with other people, whatever community it is. Chart Guys community is great, but there's plenty of them out there. Even when Twitter is a bit of a cesspool at times. The emotions just run rampant, right? One thing that I do in the Chart Guys is I'm always playing devil's advocate. Where if we're in massive euphoria, I'm taking the other side saying, hey, just remember, and when we're in massive fear, again, I just try and balance things out a little bit, because the last thing you want to have is groupthink of emotions taking hold. And oftentimes on Twitter, with no moderation, obviously, and no point person or leadership, that you can get that echo chamber where it is all one-sided. And so we definitely want to avoid that. I want to be looking at both sides of the trade always. Do good things. Thanks again for sticking with me. I'm proud of you for it. If you made it through this, I'm proud. I traded some digital numbers for some shiny rocks. Petrified wood. Labradorite. And this is the winner. Petrified wood from 77 million years ago. Meteor hits Alabama. It's a monster. Crystallization. Termite holes. Shout out to Bruce, who was sad to part with this piece.